Hey, Steve Saretsky here. As always, Canadian real estate market update, a particular focus on Vancouver. If you're getting sort of value and entertainment out of these videos, all I ask you to hit thumbs up and subscribe. Questions, comments, put those below. Want to touch this week primarily on the Canadian housing market, kind of how, all the data inputs that I'm looking at and how I'm putting my sort of framework together moving forward. Because we had the most recent CPI inflation print in Canada coming in at 5.7%. So that's a 30-year high in the inflation rate for the month of February. Again, if you've been watching these videos for any length of time, you know that we've been talking about this for a while, that it hasn't been transitory. And so, that's now factoring into obviously calls for central banks to fight inflation. And I'm not going to get into the reasons why I think they're going to be unsuccessful intentionally on fighting inflation. I will just simply post this chart here from Lynn Alden, which basically shows that central banks, the last two times we had inflation at these levels was the 1940s and the 1970s. In the 1940s, they basically let interest rates essentially not reflect the rate of inflation. They actually ended up pinning rates because we had large debt to GDP imbalances and we had a war that was ongoing. And in the 1970s, they opted to go the other route, which was to fight inflation by raising interest rates. And obviously, we all know how difficult of a time that was. And so we fast forward today, I think we have debt to GDP balances which are incredibly unsustainable. And I think we do have a war. Not only was there a war, at least in the government side, was there a war on COVID, but now there's a war on Russia. And I think moving forward, governments will use the war on climate change, whether you believe in that or not is irrelevant. I think they will use that to fund their spending programs and, manipulate interest rates, etc. So, that's neither here nor there. We have central banks clearly, at least in the early days here, of raising interest rates, of saying they're going to do the right thing, the moral thing, which is to fight inflation and raise interest rates. But need I remind you that the Bank of Canada's interest rate policy right now is sitting at 0.5%, 0.5%, with inflation running at 5.7%. Of course, I think we know that that number is arguably higher than 5.7, and it's going to move higher than 5.7 over the coming months before ultimately peaking and rolling over, which I think is probably what's going to happen here. So I think at the end of the day, we're still facing deep negative real interest rates, and that's obviously sparking and propelling the Canadian housing market. All we have to do is look at the national home data, which came out for the month of February. So you had national home prices in Canada rising by 3.5% on a month-over-month basis, 3.5%. So the national home price index, which is like a smoothed-out index, jumped from 3.5 from January to February. So you had a 3.5% increase in home prices. Home prices are now up just over 29%, just under, let's call it basically 30% from last year, a massive increase. And so what you're dealing with today really is incredibly low supply levels. So you've got the months of inventory, which is really the most important metric. It kind of filters through all the noise. Months of inventory is sitting at 1.6. It's the lowest ever on record, tied with January and December. And so this is kind of the supply-demand imbalance, which is obviously creating 30% price growth on a year-over-year basis. Now, I do want to add a caveat, which I talked about in the Loonie Hour, so feel free to go watch that. We also had some commentary on the U.S. Federal Reserve in terms of their rate hike path. But that MLS benchmark price, what I will say is that it is a lagging indicator. I think for all intents and purposes is that we are starting to see the national housing market beginning to turn and beginning to make a slow pivot. And I'd like to emphasize that when housing markets start to change course, it's like a cruise ship pulling a U-turn. It doesn't happen overnight. Sellers, just because they don't sell in the first 5 days, don't start cutting their prices. In fact, like I said, if you look at it from a seller's perspective, you're still sitting at 1.6 months of inventory on a national level. There's no reason to panic and start cutting prices, and that's exactly what they're not doing. Because the reality is that the market is still very tight. You're still seeing a lot of multiple offer situations. You're still seeing prices selling over ask. You're just seeing less buyer activity. So instead of 8 offers, you're seeing 2 or 3, and you're seeing basically those prices beginning to stabilize. And you're seeing some people, have failed multiple offer bidding strategies. So, you under a house that might be worth 1.7, you price it at 1.5. Well, guess what? It only gets bid up to 1.65. Uh-oh. And so what happens is the seller then says, oh, well, I actually don't want to sell for 165. And so what they end up doing is they end up taking it off the market and relisting it at that, price that they feel it should be worth, which is 1.7, and then waiting for that one buyer to come in. So you're seeing more and more of that, and that's kind of the indications that the housing market is beginning to change course. And so that's kind of what I'm ultimately focused on, because what we have here is, we are in a situation, as we've talked about, that rates are going up, and they will continue to go up until something breaks. Again, my view has been that something is going to break much quicker than people anticipate. As I've said, the central banks are just beginning the rate hiking cycle now. I mean, they should have started 6, 7, 8 months ago minimum. They're starting it now as the housing market, like we just talked about, I think has peaked for all intents and purposes. Let's wait, let's see. It's still early days, but I think that this is my call, and you guys know that I've been very vocal and very honest with my calls over the years. If I feel confident about something, I'll come out and say it. And just like I said that this was going to be a massive bull run, 2 years ago, that's what we had. Lo and behold, up 30% just in the last 12 months alone. So I think that what we're going to see here is, as rates go up, you're going to see that softening the housing market. So we've got mortgage rates today. The 5-year fix is creeping up to about 3.1, 3.2% on that 5-year fix. Keep in mind, at the pandemic lows, that was around 1.5%. You could have locked in a 5-year fixed mortgage at 1.5. The variable rate is now starting to change as well. As the Bank of Canada raises interest rates, that variable rate mortgage will increase. You're also seeing banks, from a risk perspective, are starting to shrink the discount on those variable rate mortgages. So, for example, you could have picked up a variable rate mortgage on the lows at 1.2%, such as I did myself. You're probably looking at about 1.8% today, and probably in April you'll probably see that jump up to over 2%. So you're starting to slowly get there in terms of rate increases. The key metric, if you want to get an idea of where mortgage rates are going, all you have to do is watch the Canada 5-year bond yield. Again, the 5-year fixed mortgage in Canada is priced off that 5-year bond yield. And so we now have that bond yield just moving up in recent weeks. That's now surpassed. It's now north of 2% on that 5-year bond yield, which is, the last time it was at these levels was in 2018. Of course, if you remember 2018, that was a very soft year for the housing market. In Vancouver, we had an 18-year low in home sales in 2018. And in the GTA in Toronto, you had a 10-year low in home sales that year. So that's kind of what I ultimately think, is that it is going to slow housing activity. It's going to be, we're coming off obviously back-to-back years of record home volumes. So a lot of housing demand has been pulled forward. And so I think that the inevitable housing slowdown is right around the corner. Now, again, how does that come with price discounting? That remains to be seen. I think at the end of the day, we are still running into a situation where inflation at 6%, mortgage rates at 3%. It's still a real negative interest rate of negative 3%. So it's in that environment, it's still becoming challenging for me to be bearish on the housing market. But again, if these mortgage rates get north of 3.5%, closer to 4%, and they hold. The key thing is they got to hold. They have to hold there for 6-7 months. Then I think you're going to start to see some price discounting. I think that the suburban housing market, I almost look at that as like the tech stock market, right? Like if you look at all these big tech names, Facebook, PayPal, Shopify, massive tech company names that obviously benefited from the pandemic. I think the suburbs could be similar in that market, where you see those markets come off. Again, I don't think it's a 50, 60, 70% move like you saw in PayPal or Shopify, but I think you will see some discounting. Could you see 5%, 10%, 15% in the suburbs over the course of the next 12 to 18 months? I think that's a very realistic scenario. Now, again, keep in mind, as I've talked about at the beginning of the show, months of inventory is still at historic lows. So you're not going to see 2 weeks from now, people discounting their prices. What you are seeing is a leveling out. You now need to get inventory levels from crisis levels, which is where they're at. You need to get them from crisis levels up to normal, balanced, healthy levels, and then you'll start to see days on market creep up, sellers slowly starting to discount their pricing, and that is going to take some time. And lo and behold, rates should obviously help with that. So keep a close eye on your 5-year mortgage rate in particular. Now, because the variable rate is still extremely low, I want to remind you that basically throughout the last 1.5 to 2 years, roughly 60% of new mortgage originations has been going variable. Why? Because there's about 100 to 120 basis point spread in the difference, right? I just talked about picking up 5-year fixed mortgages at 3.2 and variables still at 1.8. There's no surprise that people are betting on the Bank of Canada. You're basically betting on 6 rate hikes from the Bank of Canada, which again, markets are saying they're going to get this year. I certainly don't think that's the case. You guys know my call. It's been for 3 or 4, but we'll wait and see. I think a lot of this is just looking at the bigger picture, which is that this is an unsustainable debt picture. Look at the largest bore, the Canadian government. Their budget deficit's set to continue to balloon even further, which is all contributing to house price inflation. We've now, since this is one of my favorite charts, officially, it took just over 6 years, but national home prices have officially doubled under the Trudeau government since he was elected in November 2015. They have officially doubled. And so, again, keep in mind that everything that we hear from governments, politicians, central bankers, it's all kabuki theater. They'll tell you what they need to tell you, and they have failed to deliver on that. They'll tell you what they need to do to instill confidence and stay in power, but I think it's been proven time and time again that they haven't necessarily acted in unison with what their words suggest. So that's kind of how I'm looking at the markets. And keep in mind, I had some people pushing back and saying, yeah, it's not Trudeau's fault. Home prices are up across the world. And it's like, well, no, Canada had the fastest pace of home price inflation in the G7 over the past 5 years. So a lot of this is policy decisions, right? We've talked about this before. Policy decisions, first and foremost, immigration targets. The fact that you ramp up immigration targets without having an adequate housing supply mandate in place was ill-cited. It was a policy error. Again, these are all policy decisions that they've opted to make. If you run massive budget deficits and hand out $3 in income for every $1 of lost income during the pandemic, you overstimulated, and a lot of that showed up in credit demand in the housing market and thus higher prices. So I don't like to let off policymakers and suggest that this is all free markets, because I think that policymakers are always at the lever. They're always in relative control of what they want to do. And so I think that they have to take responsibility that a lot of we could have easily had, instead of 30% price appreciation, we could have easily been at 15 with the right policy levers in place. So I'll kind of leave it with you there. But that's kind of how I'm looking at the housing market right now. I think that central banks are acting tough. I think that they have to raise rates I think there's a lot of political pressure on them. I think they're going to continue to raise rates here moving forward until something breaks or starts to wobble. I think that's coming sooner rather than later. As we've talked about, the housing market is beginning to slow down. It will take some time, but as those rate hikes filter through, as those mortgage rates creep up, now at 3.2, potentially going to 3.5, 3.6, 3.7, I think that's when you start to see a real softening in demand, and you start to see people pull back on future investment. So that's how I'm looking at things. As always, we hope that helped. See you next week.